Welcome everybody to this week's Middle Class Investor. This is Seth Martin, your host. It is Friday the 13th, 10 till 8 in the evening, and we're looking at the S&P 500. And as you can see, we had an up week, finally. Well, I mean, we had one here too, but we've had 1, 2, 3, 4, 5 weeks, and three of the 5 have been down. So we had an up week here and an up week here. I'm going to put this on the daily chart because I want to point out. So the question is, where does the market go from here? And that's always, first of all, that's very difficult to predict, and really nobody can. That's the simple truth of it. But what's interesting here today is we gapped up. I'm sorry, yeah, we gapped up a little bit, actually quite a bit. We gapped up all the way to here, ran up a little bit, ran all the way down to here, and then closed right here. So this is a fairly bearish looking candle, but then, you always need, anytime you have a bearish candle or a bullish candle, you need to know, what's the next candle look like. But the main reason I wanted to go to the daily chart is I wanted to point out these gaps. There's a gap right here. There's a gap right here. And anytime, I pointed out these gaps back here and right here. Anytime there's gaps on the chart, they usually get filled. So, I don't know. To me, I'll show you some charts where this looks pretty bearish. You can clearly see the A, B, and then C kind of ending diagonal C with the sell-off here at the end. But there are gaps on the chart. We could, maybe go down a little bit further and then start making a move up into here, which would be, which would retrace quite a bit of this move here. This is clearly a 5-way move down here, though, as is this. So you've got two, I used to, when I was studying Invest Tools, there was Dave Johnson, and Dave Johnson always talked about weight of the evidence. So you got these two big down moves, and then you got this really choppy action in between. And this is classic bear market looking. Okay, now the media talks about a bear market. There's a bear market when the market's down 20%. Well, we're not down 20%, but trust me, when this next move goes, it will be well below 20%. We will definitely be in a bear market. Of course, you don't want to wait to that. You want to try to get out ahead of things. But there is a question as to whether or not we're just going to go down from here and start making our way down, or are we going to go down a little bit and then kind of rally back up, close these gaps. I don't know. Closing these gaps, but then having these stay open, I don't know what that means. I'm not used to that. Doesn't happen very often, and it's possible it could happen here. But I will say, for the bulls, we are on this primary degree support. Okay, we're sitting right on it, and we bounced off of it here. We bounced stuff off. We kind of breached it, but then bounced off of it here, and also, I think there's a lot of bears in the market right now, so that they tend to be wrong. Sentiment tends to be just the opposite of what the market does. So, excuse me, sorry about these coughs. So if the market is very bearish right here, it probably portends this to be the case. We're going to drop a little bit and then run up. Usually, and then what'll happen is that'll set the bulls, running. You got a higher low, and then you would have a new higher low, let's say right here, and that's going to get the bulls all hot and heavy and get the bullishness back up, and then maybe, we sell off from a higher level up here. But this action right in here looks very bearish, and I'm going to show you a scenario here in a minute where it could be bullish. Okay, but let's go look at some other charts. Let's look at the 10-year yield. 10-year yield started to move up this week. I'm going to go back to a weekly. The 10-year yield started to move up. It was up last week, but just slightly, and then we didn't close above this candle, so that's not entirely bullish yet. So we could get a little pullback, maybe another pullback, and then start rallying up. But it looks like maybe we've put in a low for the time being on yields. I mean, clearly this right here, is a pullback. So, but it looks like maybe it's complete. We might get a candle next week that looks, kind of like so, and then the following week, we start moving out of here like so. Okay, that's what I would expect here with yields. I mean, it could be that we run up maybe to here and then pull back and make another low into this box, with a double, kind of a double pullback. It's called a double zigzag. But it's possible that yields just take off from here. So if you're in those bond funds, be careful. You're losing a lot of money right through here. From October of last year through here, a lot of losses in bonds. You've got some of it back here recently, but this is a pretty significant loss in bond portfolio right here. All right, let's look at the 13-week Treasury. This is the one we use to kind of see what the Fed's likely to do. And while my internet connection is so slow tonight, the AT&T people are Cadillac in here. Let's take it off log. So you can see here yields even in the short term. The short-term yields are moving up. Here's the pullback. It could be again that we pull up and then we pull back a little bit further and then start moving out. But this could very well be it. I mean, from a trading standpoint or from an investing standpoint, you may not want to be long yields until you actually break this high, the high of this candle right here, this candle right there. So break out above this high. But I think, the Fed. There's a lot of talk about the Fed, and my hope is that the Fed just gets discredited in this whole deal, and that people hate the Fed afterwards. So, volatility. Volatility pulled back a little bit here, and which is kind of interesting because, like the market today. Of course, we're looking at a weekly, but the market today, was up like 160 points on the Dow at the open and closed down for the day. So that's usually not great when the market's closing lower on the closes, especially after being up. And volatility really didn't do anything, so that's kind of interesting. It's kind of in a little flag pattern here. But when volatility starts to move out, people are going to be very uncomfortable in the market, and you're going to see selling for selling's sake. Let's look at the countries real quick. Germany, again, their market looks a lot like our market, and I think we've got kind of as a global phenomenon. I know Peter Schiff talks a lot about investing in foreign countries, foreign assets, and I don't know. Peter Schiff's been at this for longer than I have, and he's a smart guy, but I just think it's more likely that it's a global phenomenon. He's looking for the dollar, for example, to sell off right here. Yeah, I'm gonna have to look at the ETF because I don't know what the symbol is on. But ask yourself this question. This is the dollar over the last 5 years. So we ran up, kind of chopped sideways. Looks like a corrective, right? Like this could be a wave 3, and this all could be a wave 4, maybe a wave 5. Okay. And so the dollar's pulled back here since the beginning of 2017, and this looks like kind of a wave 4. in this move. So you can kind of see a 1, 2, 3, 4, 5. So is it likely, that the dollar, continues to fall from here, and crash, as Peter Schiff says? I don't know. I don't think so. I think what's more likely, and this is the tricky part in the market. This is what throws so many people off. So once you have 5 waves, you can clearly see it right there. The first likely move, the first is up to about there, or at least there, let's say. So this is likely to move up to here, and then pull back a little bit, and then take off again. Okay, so I just don't think the dollar is it's in a position to crash right here. So I think Schiff is wrong, and I think he's not often wrong, but I think he's wrong here because I think he will be right eventually. But I think the challenge with this topping process that's been going on for so long, some of you may have heard, this is the most hated bull market in history. This run up, maybe starting in here somewhere up to here. It's the most hated bull market in history because, there's been bearish. People have lost a lot of money because they're just bear, and they made money here, but then bear. They're bear all the way up, and so that doesn't do much for your account value. So, and I think the challenge. I don't think these people are wrong that are bearish. I think what's happening is that it's just taking. Let me pull up an all chart. I think this topping process starting here in 2000, with this kind of wave forward, just took a long time. I think in 2000 after the .com and then the rally up. I mean, people were even starting to be bearish here. And of course, they were rewarded during the financial crisis. But just this whole area right in here, from about 2003 or 4 on, it's just been just a constant drumbeat of bears. And you had, we weren't around back then, but you had the same thing back here in the 68 to 74 bull market. And so what you find, if you look at this closely, is this bull market is very similar to this. This bear market right here is very similar to this bear market that we've had here. This one resolved itself, Reagan came into office and, blah, 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 and everybody felt great, and so the market ran up. But if you look at the internals, like Elliott Wave does, they study the internals over this move, and they compare them with the internals over this move. This move here was a lot stronger than this move right here, which is typical of a fifth wave. So what happens after fifth wave? We at least go back to the fourth wave low, in our case, which would be below this 750 here on the S&P 500. And potentially, that may just be the A wave. Potentially, we come all the way back here to the 74 bull market low. I know that's crazy stuff, but that's what we're talking about here. So, all right, let's switch over to the other charts and pull up. Let's look at. Let me get it on a weekly. Sorry, I didn't have my chart set up before. Let's look at the euro. So we were talking about the dollar earlier. Well, the dollar and the euro move opposite of one another. So again, you can kind of see a 5-wave move here up in the euro. And so, once you have 5 waves, you get some sort of correction, right? So, it's likely that we're going to see some sort of correction in the euro, at least down into this area, the 108, below 110 kind of area. Below here, into this area right here. So, and if you look at the commercials versus the trend following groups, and commercials are usually right at the turns. Okay, so what does that mean? If the commercials are short here and the trend followers are long. What does that mean? That means the commercials are usually right at the turns. So that means this is likely a turn in the change in direction. Because commercials, by the way they trade, because they're primarily hedgers, um, they're taking the other side of trades all the time. So if a lot of speculators and individual traders are long here, they're expecting this. They're expecting this here. Let's zoom in and let's talk about this for a second, because this is important stuff. Um, they're expecting this sideways pattern to be what's called a trend continuation pattern. So here's the trend. We consolidate for a while, and then boom, we break out and continue higher. That's what trend followers are expecting. But commercials, what they do, they have to kind of protect themselves against that kind of activity. So they will take the other side of those trades during these consolidation periods. So a lot of times that makes them, you want to see where they are during these consolidations, or even in this area here. What are the commercials doing right in these 3 or 4 weeks here? Because they're usually will tell you that, hey, the market's doing this, okay, it's rolling over. Or if it had been going the other way, let's back up and show you. Let's back up and look here. Zoom in right here. So right in here, see commercials were, now it's easy to see in hindsight, but the market's coming down. So trend followers are going, oh, this is going lower, it's going lower. Commercials come in and they say, nope, it's going higher. And so they're taking the other side of those trades. So anytime you have a turn in the market, the commercials tend to be right and the trend followers tend to be wrong. Okay, that's just the data. There's nothing, it's really not in dispute. Anybody can go look at that data and see that. So, I would say the likely direction of the euro at this point is down. Okay. US dollar CAD, we've been looking at that. This may look scary here, but this is potentially a very good trade. So, we've got a low, we got a higher low, we got a breakout of a down trend line, and we got a pullback to the trend line. Okay. So maybe what's next is we get a candle like this that kind of gaps higher but doesn't really run very high, and then like this, and then maybe the next candle we get looks like that. Well, that's bullish. Okay, that means you want to be long this instrument. Now, where's your stop? Well, your stop is below here. Okay, you take a stop here, but where's your target? If I got in right here, okay, I'm looking for this thing to go beyond, up here. So what I could do is I could see how it acts right here. Okay, so I could expect the first not even slow down until it gets there. Well, that already looks like a pretty good reward to risk, right? Here's your risk right here. RI. And then this part right here from this box to here would be reward, RE. Okay, so that's pretty good. I mean, that looks like maybe a 2 to 1 or more, maybe 2.5 to 1. So you buy here. If you're wrong, you're out here. If you're right, you're out here. Or maybe you take some off the table, because it's going to pull back here. It's going to pull back or trade sideways, and then look to re-enter and take it to the next pivot, which is way up here. So, all right. So that U.S. dollar CAD is. And let's think about it. Does that make sense? If the U.S. dollar goes higher, well, that makes sense, right? That means compared to the Canadian dollar, that this chart should go up. Okay, so if the U.S. dollar is going higher, and we're looking at a ratio of the U.S. dollar to the Canadian dollar, then that would make sense. If we think the dollar is going to go up, that would make sense that we would have a move up in the U.S. dollar CAD. Okay, and this is usually. So what do we see? Let's talk about what we see here. Big picture. We're on a weekly chart, okay? So we're looking at a huge time frame here. We got this big move down, another move up, and another big move down. Does that look like an ABC? Okay, what do we know about ABCs? They're corrective moves. So we've had a move up, we've had a pull back to a higher low, we've had another move up, pull back to trend line test. If we get another move up, this is going to be significant. I mean, you could trade it up to here, but really the better goal is to trade it up here to 1.48 or so. And so when you do the math on this, this is a huge reward, risk reward trade. Okay. British pound US dollar. The British pound US dollar has been going up. So we would expect, with the US dollar being in the denominator, we would expect if the dollar is going up, we would expect this to be pulling back at some point. But we kind of see something similar. Whoops. Kind of see something similar here. This huge potential ABC pattern. But this also could be like a 1-2, 1-2. So, I don't know. I feel more confident that the dollar is going to be going up. So maybe this trade is not as good long term. But it doesn't mean it's not going to go up. It just means it might not go up as fast. Let's look at gold real quick. Gold and silver look radically different. I need to take some of these lines off the screen so it's not so confusing. Gold looks like it definitely wants to be in a bull market. The silver to me looks like the bigger opportunity, because if you look at it, you kind of got, and you almost have this like down. You got this big downtrend here. It's almost like an ascending triangle. And so the way ascending triangles work is, this height right here, whatever this height is, on the breakout, you can add this height to the breakout. So let's say, that box is. And the interesting thing about that is, where does that take you? It takes you right to our DP box. So silver looks really good here long. If you wanted to buy some, again, we have a pullback to a low, right here, and then these are all higher lows, right? I mean, these are the same lows, but this whole pattern here, there's a lot of bearishness you would have to, or bullishness you'd have to chew through to be wrong, below here. So to me, this is a very low risk trade. You could buy this breakout, trade it up to here, or buy some silver here and hold it. It's a great place to. Now that doesn't mean silver's not going to get here and then, go down. I mean, our longer term view of silver is that we're probably going to come down to this box. So let's zoom out of this and look and see what these boxes are. So we're talking about short term to intermediate term, a trade maybe up into this area around 23.20. But we're expecting silver to test this fourth wave low over here, which is around $7.50. But I've talked about that before. Who knows what's going to happen? It may be that you can't even buy silver. By the time it gets back down here, maybe you can't even buy it. I don't know. Or maybe the commissions on it are so high that it's the same as buying silver right here. So if you want to buy silver, what I'm saying is this is a good place. This is a good place to buy. I mean, obviously this is better, but this is more risky, right? You don't have all this evidence here of bullishness. So right here, there's a lot of evidence for bullishness. You've got really good support here. So if it does pull down and you're wrong, well, hey, you're wrong, and that's that. But you still made a good trade, okay? But I think the evidence is showing that this is a good place to buy silver, and at least up to 23, maybe even up to this $26 area. Okay. All right. Let's see what else we can look at. Let's look at oil, crude oil. Crude oil made a higher high, which was really surprising. I'll be honest with you, I was surprised because this looked very corrective. And maybe this is a B wave. This could be. Sometimes what happens with Elliott wave is you get what's called a flat. So, in other words, this is the top of the impulse wave, and you have a situation where this is A, B, C. Of course, that'd be bullish though, right? So that can't be a B wave. I mean, it could be we're just wrong about oil. I don't know, or it could be that I don't know. Oil, I'm confused about, but We are at resistance, even though this is such a huge candle. I mean, this, you don't really see I mean, this could be like a blow off top, kind of thing, is what we're seeing here. I don't really know. Commodities trade a little different than stocks and indexes. They tend to, commodities tend to, if you go back, let's go back to gold. I'll show you what I mean. Look at gold. Let's look at this last run up here. See how sharp this run up is right here? This is typical of commodities. This is just, look at the slope of this thing. Straight up, okay? And the reason that happens is because there's a lot of fear here. There's actually fear that's driving this prices higher. People are trying to hedge themselves and stay out in front of this because they have operations to run, and there's a lot of fear going on right here. In stocks, you just look at the ES or look at the S&P 500. This is not this ending here is not fear. This is hope. This is people stepping in, going, "Oh, I hope it goes. I'm going to buy the dip. I hope it goes higher. I'm going to buy the dip. I hope it goes higher." This is exuberance. This is bullish and just gone amok. Okay, and that's different than fear. And really, it's hard to see on the chart. But we can see how abruptly, gold sold off. It just immediately sold off, and I don't know. To me, it in this case, it kind of looks the same as the market, but it feels different. There's something about it that feels different. Maybe it's just my lack of understanding of commodity trading, but anyway. All right, I want to switch gears and look at. So I want to show you a couple of patterns in EWI. So if you look at a 30-minute chart, okay, 30-minute chart. So this is very short term. You can kind of see here. Let's zoom in a little bit and color over it. So you've got this. Well, let's back up first. Well, I can't see it there, so let's not worry about it. Let's zoom in. So you've got this. You got this A, B, C. Actually, you got this A, B. Okay, so these are, kind of three-wave moves, A, B, and then C. If you look at it, see how it kind of goes A, B, C, and they're showing that as 1. And then you can see an A, B, C, and they're showing that as 2. And then there's an A, B, C, 3. And you can't see the A, B, C in here for 4, which means it might not be there. But then you see this run up where it breaks the trend line, and they're calling that 5. This thing right here is known as an ending diagonal. And it's a terminating type pattern. So if this is an ending diagonal, that's really the best way to say it. If this is an ending diagonal, and this is wave 1, and this is wave 2, then ending diagonals are trend terminating patterns. So that means this particular trend is over. Okay, if that's an ending diagonal. Now, the thing about chart reading is it's a little bit subjective. So here's another view. Now this is on a 120-minute chart, which is interesting because these look different, or they drew it differently, support and stuff. So A, B, C, where C is A, B, C 1, A, B, C 2, A, B, C. Well, see here, A, B, C. They didn't put the 3 there. They made it like an A, B, C, X, C 3. So they put there's like an X wave in here. That's what they call an X wave. And then 4 down. So what does that mean? That means that we could have a run up. Okay, so remember I talked about closing those gaps that are way over here somewhere? We could have a run up and then a drastic sell-off. Okay, so there's kind of 2 different scenarios, and I would say it depends on how things open. If the market opens down, let's say the market gaps down to right there, okay, and then kind of works its way back up and then sells off, then I would say the first pattern is accurate. Okay, the first one we looked at is the right one, this one. Okay, but if the market gaps up and starts running up and then pulls back and then runs up some more, obviously this one will be more accurate. Okay. Now, Deneric, sometimes I pull Deneric's charts up on here. Now this is the Wilshire 5000, and he uses the Wilshire 5000 because he believes it makes better charts. But you can see the gap here, and of course there's another gap up here, but I don't think we're going to close it. But what he's showing is, well, this could be two could be complete. We've done a 50% retracement of this move right here, 50% retracement of this move, or he's saying, hey, this could come down, and this could be like an X wave here, and then C up to 61.8 or the trend line right here, and then down. Okay, so I think it all depends on what happens on the open. If we gap down, but then kind of run up and close the gap and then sell off, then I think 2 is in. Okay, but if we gap up, sell off, and then move higher, well, then I think we're looking at this 2, and it's quite a bit higher. I mean, you're talking about, I don't know what that is, maybe 2% higher, so, and maybe 4% from where we are right now in the market. So, this kind of stuff is where that saying, bulls get rich, bears get rich, and pigs get slaughtered. If you're a pig and you're really trying to be greedy here, I mean, and you catch this wave 3, if this is going to be wave 3, then you can get slaughtered. Okay, your account can be slaughtered, and before you can even really respond to it, you're down 20%. So just be aware that can happen, and that's why this chart reading stuff is so important. A lot of people don't believe in it. A lot of people say, how could it be that everything you know or everything you need to know about the company or the market is on the chart? Well, go study companies and buy based on EPS and balance sheet and all that stuff, and see if you can make any money that way. The professionals make money that way, but they have huge amounts of money. They have very active people. It's a different game. It's not a game that the average person can play and win. Whereas technical analysis really is, because you can decide where you want to be in, where you want to be out, and where you're wrong, and where you're going to take profits. And that's a game you can win if you have pretty good rules and you're disciplined. But that's for another time. I guess that's about it. Let me pull up, it's almost about it. I wanted to pull up this chart. This is you can't see it here, but it's a 60-minute chart. And what you can see, this is my MT Predictor software running on NinjaTrader. You can see this swing, okay? This is the second swing down. So remember earlier I showed you that big red line and then another big red line. And I said those were impulse waves, and these waves up were corrective. Well, you can see here, let me clear last. No, that didn't do it. Let me clear all. You can see here we have a TS4 Holy Grail. So Holy Grail just means, the other thing I can show you is, let's say we have an up wave 2. So let's say this was a wave 1 from here to here. So 2, see there's 2 or B, we're right there where a wave 2 would be. Now, again, this could make another move higher, and we would still be in a wave 2. Okay, this ABC would still be a wave 2, just like Deneric showed, just like Elliott Wave showed. But it could be that we end up running up a little higher. Okay, in fact, if you take a DP off of this previous swing, so this high right here is important because it's the pivot off of this low. Okay, so this is a very important high here. So if we take a DP off of it and zoom way in, okay, you can see we haven't quite reached it. See how that the candle ended here, but the DP's up here. So it's highly likely that this could turn and this could run up here, but then sell off. So again, look at the open. If we gap up on the open, pull back, and then continue to run up, then look for the market, at least on the futures, to turn somewhere around this 2685 area, and then wave 3 begin. Okay. All right, everybody, that is it for this week's Middle Class Investor. Thank you so much for coming in and listening. Don't forget to forward YouTube links to your friends, families. It's really getting to the point. It's getting closer. Certainly the bond market, if they have bond funds, are already losing money on that. So even though we haven't topped in the market, you really ought to send them the link. Tell them, encourage them to listen. I haven't been very active on Twitter. Mainly, I'm just not a big fan of Twitter. But if things start getting crazier and I need to be more active on Twitter, I can do that. But I like to use this format because it demonstrates, or it's easy to illustrate why we're kind of positioned the way we are, thinking about being positioned a certain way. Okay, hope that helps everybody, and take care, be good, and we'll talk to you next week. Thanks, everybody. Bye bye.